studying your last two. I swim with tea when they turned in. The staring down to mute. And can learn the pole that sunk he died.
We've now seen how interest income and dividend income are reported in a corporate tax return. Next, let's look at another important type of investment income: capital gains. For capital gains, the reporting process always begins with Schedule 6. Before we can prepare Schedule 6, we first need to identify where the gain came from. Let's start with the investment lifecycle shown on the left side of the slide. The process begins when Barnes Dentistry purchases an investment. This could be shares, mutual funds, marketable securities, or another capital asset held by the corporation. Over time, the value of that investment increases. As the market value rises, the corporation develops an unrealized gain. At this point, no tax reporting is required because the investment has not yet been sold. The next step occurs when the corporation disposes of the investment. In our example, the investment is sold for a higher amount than its original cost. Once the sale occurs, the unrealized gain becomes a realized capital gain. This is the event that creates a reporting requirement for tax purposes. Now look at the center of the slide. When reviewing the financial statements, we can see a highlighted item labeled capital gain on investments of $10,800. This is the amount that immediately attracts the attention of a tax preparer. Whenever you see a capital gain reported in the financial statements, your first thought should be, this belongs in Schedule 6, not Schedule 7, not Schedule 1, Schedule 6. That's because Schedule 6 is specifically designed to calculate and report capital gains and capital losses. Now let's talk about what a capital gain actually is. A capital gain occurs when an investment is sold for more than its adjusted cost base, often called the ACB. The basic calculation is simple. Capital gain equals selling price minus adjusted cost base. If the selling price is greater than the adjusted cost base, a gain exists. If the selling price is lower than the adjusted cost base, a capital loss exists. One of the most important concepts in Canadian taxation appears on the right side of the slide. Only 50% of a capital gain is taxable. This means the gain reported in the financial statements is not automatically the amount that enters the corporate tax calculation. Schedule 6 must first determine the taxable capital gain. That's why Schedule 6 is a critical step in the reporting process. Now let's look at some common beginner mistakes. Many new preparers report the capital gain directly in Schedule 7. Others skip Schedule 6 entirely and assume the financial statement amount is already the taxable amount. And some forget to apply the 50% inclusion rate when calculating taxable capital gains. These mistakes can result in incorrect taxable income and inaccurate corporate tax calculations. The key takeaway from this slide is simple. Whenever an investment is sold and a gain is realized, the process begins with Schedule 6. For Barnes Dentistry, the financial statements show a capital gain of $10,800. That amount is the starting point. Schedule 6 will then determine how much of that gain becomes taxable before the information flows into the rest of the T2 return. In the next step, we'll prepare Schedule 6 and calculate the corporation's taxable capital gain. Now that we've identified the capital gain in the financial statements, the next step is preparing Schedule 6 and calculating the taxable capital gain. This is where the accounting gain is converted into a tax amount that can be used elsewhere in the T2 return. Let's begin with the investment sale details shown on the left side of the slide. Barnes Dentistry sold an investment during the year. The proceeds of disposition, which is the selling price received, were $35,800. The adjusted cost base, often called the ACB, was $25,000. There were no selling expenses associated with the transaction. These three numbers form the foundation of the Schedule 6 calculation. Now let's move to the center of the slide and work through the calculation step by step. The first step is determining the capital gain. We start with the proceeds of disposition of $35,800. From that amount, we subtract the adjusted cost base of $25,000. Since there are no selling expenses, no additional deduction is required. The result is a capital gain of $10,800. This is the same amount that appeared in the corporation's financial statements. At this stage, many new tax preparers make an important mistake. They assume that the entire $10,800 becomes taxable income. However, Canadian tax rules treat capital gains differently. Only a portion of the gain is included in taxable income. This brings us to the second part of Schedule 6, the taxable capital gain calculation. For this example, the capital gain is $10,800. The inclusion rate is 50%. That means only half of the gain is included in taxable income. The calculation is straightforward. $10,800 multiplied by 50% results in a taxable capital gain of $5,400. This taxable capital gain is the amount that matters for tax purposes. Notice the large highlighted figure in the center of the slide. $5,400 is the number that will move forward into the next stage of the corporate tax return. The original gain of $10,800 remains important for documentation and reconciliation. But the taxable capital gain is the amount used in the tax calculations. Now take a look at the tax preparer checklist on the right side. Before finalizing Schedule 6, a professional preparer will verify the proceeds of disposition, confirm the adjusted cost base, review supporting investment records and sale documents, calculate the gain correctly, apply the 50% inclusion rate, and ensure the taxable capital gain is transferred to the appropriate area of the return. These review procedures help prevent one of the most common errors in corporate tax preparation, using the accounting gain instead of the taxable capital gain. The most important lesson from this slide appears in the banner at the bottom. Only 50% of the capital gain is taxable. For Barnes Dentistry, a capital gain of $10,800 produces a taxable capital gain of $5,400. That taxable amount is what will ultimately flow into Schedule 7 and become part of the corporation's aggregate investment income calculation. The key takeaway is simple. Schedule 6 acts as a conversion tool. It starts with the economic gain realized on the sale of an investment and converts that gain into the taxable capital gain used throughout the corporate tax return. Once this calculation is complete, we're ready to follow the taxable capital gain into Schedule 7 and see how it affects the corporation's investment income reporting. We've now completed Schedule 6 and calculated the corporation's taxable capital gain. The next question is, what happens to that amount? The answer is that the taxable capital gain does not stay in Schedule 6. Instead, it moves into other parts of the corporate tax return and begins to affect important tax calculations. Let's start on the left side of the slide. Schedule 6 has produced two key numbers. The original capital gain was $10,800. After applying the 50% inclusion rate, the taxable capital gain is $5,400. This taxable capital gain is the amount that moves forward in the tax return. Think of Schedule 6 as a processing station. Its job is to convert the accounting gain into a taxable amount. Once that conversion is complete, the taxable capital gain is passed to the next stage. Now look at the center of the slide. The taxable capital gain of $5,400 flows into Schedule 7. Remember that Schedule 7 serves as the corporation's investment income hub. It gathers investment income from multiple sources and combines them into a single calculation. In the Barnes Dentistry case, Schedule 7 already contains interest income of $17,600 and rental income of $5,750. When the taxable capital gain from Schedule 6 is added, the total investment income increases. Let's look at the aggregate investment income calculation. Interest income of $17,600 plus rental income of $5,750 plus taxable capital gain of $5,400 results in aggregate investment income, or AII, of $28,750. This is one of the most important outcomes of the Schedule 6 calculation. Without Schedule 6, the taxable capital gain would never enter the investment income system correctly. Now let's move to the right side of the slide. Once Schedule 7 completes its calculations, the information flows into the T2 return. At this stage, the taxable capital gain becomes part of the corporation's overall tax profile. The resulting calculations influence aggregate investment income reporting. They affect passive income tracking. They contribute to corporate tax calculations, and they become part of the information used to evaluate future tax planning opportunities. This is why capital gains are much more than a one-time calculation. Their impact extends throughout the entire return. Notice the panel labeled, "Why this matters." Taxable capital gains affect aggregate investment income, commonly called AII. They contribute to adjusted aggregate investment income, or AAII. They may influence small business deduction reviews, and they become an important consideration in corporate tax planning. A seemingly simple investment sale can therefore have significant consequences for the corporation's overall tax position. At the bottom of the slide, you'll see the complete journey summarized in a simple flow. An investment is sold. The gain is reported in Schedule 6. The taxable capital gain is calculated. That taxable amount flows into Schedule 7. Schedule 7 includes it in aggregate investment income. The information moves into the T2 return and ultimately contributes to the corporation's tax outcome. This flow is the mental model every tax preparer should remember. Investment sold. Schedule 6. Taxable capital gain. Schedule 7. AII. T2 return. The key takeaway from this slide is simple. Schedule 6 is not the end of the process. It is the beginning of the tax reporting process for capital gains. For Barnes Dentistry, a $10,800 capital gain became a taxable capital gain of $5,400. That amount flowed into Schedule 7, increased aggregate investment income, and ultimately affected the corporation's overall tax reporting. Understanding that flow is essential because it connects capital gains to the larger investment income system used throughout the T2 return.